Once again, this is the Royal Financial Investment Group. As always, this is your host, Prince Dykes. I'm recording this video to go over a topic of the Federal Reserve interest rates versus the Dow Jones, and how you're seeing all this volatility just due to, not only because of interest rates, but every time you hear about interest rates, you see the stock market. Every time you hear about the stock market, you hear about the interest rates. Here you're going to see a picture of our Federal Reserve chairman, Miss Jane Yellen, and hopefully I'm saying her name right, Janet Yellen. Anyway, she's the chairman of Federal Reserves, and you always see her speak or whatever. Today's video is just going to be a picture. It's not going to be, me. It's a little dark outside. I couldn't get the lighting right and stuff like that. You may hear a couple cars going by. I'm here live in Japan. So, anyway, let's get straight into the topic, because I know you guys don't have a lot of time, and I don't have a lot of time either. So, anyway. So interest rates and how they relate to the stock market. The reason why interest rates and the stock market relate, the Federal Reserve is over all banks. It's the federal bank, right? Under the federal bank, you have your bank, my bank, credit unions, everybody else, right? So banks, they borrow money from the Federal Reserve so they can loan out to people, and that's how they make their money. When they loan out to people, people pay the money back with interest, all that type of good stuff, right? So you got to think about who uses banks. Yes, people use banks to buy cars. People use banks to buy cars, goods, go on vacation, all of the good stuff. Versus businesses use banks to expand, and when they expand, they hire more people. So you guys can kind of welcome to Japan, right? Everybody want to be a drifter, right? Anyway, so I don't know if you guys heard that car streaking down the street or whatever. But back to the point. So companies use banks to borrow money, and when they borrow money, they buy more land, they build bigger things, they make expansions, they hire more people, all that type of stuff, right? So when they hire more people, it lowers the interest rates. Economy's doing good. So back to the point of the Federal Reserve. So whatever interest rate, the banks pay interest to the Federal Reserve. So the bank goes to the Federal Reserve. The Federal Reserve charges them a 2% interest rate. Hey, you can borrow this money, but you have to pay us back 2%. Bank says, okay. They go. They loan out money to businesses, cars, whatever it is. They loan out this money, and they say, well, we have to pay the Federal Reserve back 2%. So, hey, to make a profit, we're going to charge this person 5%. In business, what we call it, the wholesale price and retail price, right? The wholesale price is what the bank gets from the Federal Reserve, and as a consumer, whoever walks into the door, they pay the retail price. That's the easier way to look at it. So you can make a profit. So you get it from the Federal Reserve for 2%, you give it to the consumer for 4%. So that's essentially how it works. So the higher the Federal Reserve charges, the wholesale price, the higher the consumer is going to have to pay. For example, if the Federal Reserve charges the banks 5%, they're going to charge the banks 6%, right? Because they have to make a profit. They can't work for free. That's how banks make their money. Now, how does this correlate to the stock market? Is when interest rates go up, the more interest that a bank charges, the less people borrow. Companies don't borrow as much. Also, banks become more stringent with the way they lend out money. The requirements are higher, so less people borrow. When less people borrow, companies do less expansions, people buy less stuff. When companies do less expansions, they do less hiring, which means that their profits may be affected, and their profits will be affected because people don't have jobs and people are not borrowing as much. So you guys can kind of see how the correlation is. So when people are not buying as much and you're not making expansions and you're not growing, that means that when you go to turn in your earnings report, they will be flat or they will start to decline. So which will affect the share price, will affect investors. So that's why you see people start to sell off and stuff like that. So people believe that, hey, if the Federal Reserve raises the interest rates, it's going to affect the stock market, which it will. And the stock market is ruled by fear and greed and emotions, and which was called people to sell off. So people start to sell their stuff because they're anticipating a fall off. That's why you're seeing such high volatility. If Jane Yellen comes out and says, hey, we're not going to raise interest rates this month, we're not going to do it this year, we're going to do it another year, you're going to see the market run up. hundreds of points, over in the same day, if not 1,000. You're going to see the market run up because people think, oh, interest rates not going to be raised, things are going to be good. Because right now you have a bunch of people that are trying to time out, when the interest rates are going to be raised and when the market is going to start to sell off. So people are like, oh, interest rates getting raised, they're going to start selling. And when people selling, I'm not talking about somebody with 1 share, 2 shares, or 1,000 shares. I'm talking about people with blocks. A block of shares is 10,000 shares. So when these people start to sell off, this affects the market. That's how interest rates tie all the way into the stock market. So that's why it's a key thing to pay attention to. Because what we got going around the world, and China and Puerto Rico, and then China, Puerto Rico, and Europe, the Federal Reserve may hold off on raising interest rates. So if they do hold off, you're going to see the market take off and start running. Now, a key thing to remember, what did you just see this week? They just released the job reports. They released the job report and unemployment was low. Why did the market fall off 300%? Because people said, wow, if the unemployment is down to 5%, that would give the Federal Reserve more reasons to say, hey, the economy is doing well. It's time to raise interest rates. And when they raise interest rates, the market is going to start to decline, and I don't want to lose money. I don't want my clients to lose money, so let me sell now. And that's what you have going on in the market, fear and greed and emotions. And that is how interest rates tie into the stock market. Until the next video, you guys already know what to do. Be safe, and also don't forget to like, subscribe, comment, share, comment, all the good stuff. I appreciate and I love each and every one of you guys, and I hope you guys have a very blessed and prosperous day. Until the next video, be safe.